James, welcome. How did the Harmony portfolios fare in December?
Well, December was, I think, a fitting end to what was a rewarding year for the Harmony funds generally. All eight in positive territory again in December, albeit with the Asian funds only modestly in positive territory. And again, over the course of the year, I'm pleased to say, all in positive territory. Likewise, also over the last 5 years as well.
James, what then were the main asset allocation drivers behind performance in December?
December was a month where the equity markets added value, government bonds sold off, and so that sort of dynamic was the main driver of performance, again, as it has been for the course of the year, really, in the Harmony funds. The portfolios, compared to their strategic asset allocation, are broadly neutral to equity, so the impact there is sort of at the margin, but overweight emerging markets. That detracted from performance in December. Those markets didn't do as well as developed markets, but we're in there because we think over the longer term there's decent valuation opportunities there. In the fixed income portion of the portfolios, we're heavily underweight government bonds. Those asset classes sold off in December, again, as they have done for now the whole 12-month period. They had a poor second half of the year. We've been overweight in areas of the fixed income market such as loans, high yield, convertible debt, strategic bond managers, and more recently in emerging market debt. All of these various parts of the credit market did add positive returns, some larger, some smaller, but high yield, loans, emerging market debt, gains in the order of 50 basis points over the month, which is a healthy return when your government bond market sold off. Elsewhere in the portfolio, underweight to property securities. We've been positioned that way for the entire year. That's been an excellent position for us in the portfolios. Property securities have underperformed the broader equity market materially over the last 12 months, and we've done well on a relative perspective from that. And finally, we've been overweight cash most of the year. We're more like neutral today, but that's provided a store of value in a year where government bonds are sold off. Gives us an opportunity to have dry powder to invest in the markets as and when opportunities present themselves.
James, how then are the Harmony portfolios positioned as of today? We're going into 2014. How are we looking?
Well, we've positioned the funds to be ready for what we think is coming up in the year ahead. We're neutral to global and local markets, if you like, in each of the different fund geographic focuses. They've got a local market, we're neutral there. Overweight emerging market equity, as I said earlier, that's a really reasonably new position added in the sort of the third, fourth quarter last year. We think there's opportunities to be had there. In the fixed income markets, we remain heavily underweight government debt with positions in various parts of the credit market, high yield, convertible debt, loans, strategic bond managers, recently added emerging market debt in the later part of November, and we think again those asset classes will do well in the coming months, much better than government bonds, relatively speaking. Underweight property securities, but with an overweight in infrastructure securities to mitigate that sensitivity there. We still think property looks a little bit expensive compared to the rest of the market, despite having a poor year. Infrastructure we think represents better value today. Finally, neutralish on the cash side. We have been overweight for much of the year. Broadly neutral now. That's still a decent store of value when bonds sell off, and also a store of dry powder that we can put into the markets as and when valuation opportunities arise.
And finally, James, I'm going to have to draw you on what you're seeing looking forwards. What do you expect from investors in 2014?
I think 2014 is poised to be a very interesting year for investors. I think there's two main factors that we need to look out for. One is central bank activity, the other one is political. Political is very unpredictable. We'll put that to one side for a moment. Central bank activity, also quite unpredictable, but what we do know is that the beginning of the end is in sight for these extraordinary liquidity measures, such as the US's quantitative easing program. Having said that, it is just the beginning of the end. They're still in operation, and they're likely to be in operation for the majority, if not all, of this year. Against that background, central banks are going to avoid any other liquidity tightening measures. So we would expect a low interest rate environment, certainly for this year. We've been saying for a number of years that interest rates must be lower for longer in a deleveraging environment. We still believe that's the case. Look at any developed government you like, they are very heavily indebted. And in those kind of circumstances, we expect to see a low interest rate environment. Having said that, against that backdrop, we have to buy asset classes, we have to invest client money, we have to look for valuation opportunities in the markets. That's the most reliable indicator of likely long-term return prospects. Looking around the markets today, we still think government bonds are expensive. They have cheapened up, that's undeniable. Remember, at the start of this year, the US Treasury, the 10-year, was yielding something like 1.6. It's finishing the year much closer to 3%. It's still expensive though. It's still in the in the dying days of a 30-year bull market, and we think it's still fundamentally expensive. There are opportunities in the credit market still, but you need to watch out for the fact that the Treasury yield is going to be going up, we expect, and what impact that has on other parts of the credit market. You have to have enough running yield to compensate for that at the very least. In the equity markets, the equity market came a long way last year, particularly the developed markets. Earnings haven't kept up with that. That means there's been a degree of re-rating. They've become a degree more expensive, but we don't think they are fundamentally expensive today. They're less cheap than they were last year, but we still think there's some headroom for returns in the equity market, but we mustn't expect the kind of returns we saw last year. We expect a much more sort of normal equity market-like return in the coming year. Against all of that backdrop, finally, I think it's important to note that we do expect a return of volatility into the markets. 2013 was noteworthy because of its lack of price movements. It was a benign year, if you like. We expect 2014 to see a return of greater degrees of volatility into the markets. That's not necessarily a problem for us. As disciplined, valuation-driven investors, volatility brings opportunity, and when they are presented, we must embrace them in the portfolios.
James, thank you very much.
Thanks, Richard.